In finance, big shocks are loud: defaults, crashes, market panics. But what happens after the noise fades? What happens when the stress is no longer accelerating, but settling? That's where we are now. We've moved from the shock to the settlement. When a fund freezes withdrawals, when valuations are finally written down, when a company can't refinance its debt, the system doesn't just vanish. It redistributes. The risk doesn't disappear. It has to be assigned to someone. The final chapter of any credit cycle isn't the default itself. It's the decision, whether spoken or unspoken, about who ultimately pays the price, who absorbs the loss. There is a persistent myth in modern finance: the idea that if you slice risk finely enough and spread it widely enough, it magically dissolves. But spreading risk isn't eliminating it, it's just distributing it. Private credit markets are incredibly good at privatizing gains, but they are far less equipped to privatize systemic losses. These markets were built on a model of amend and extend, pushing problems down the road. Capitalize the interest, roll the debt forward, smooth out the reported values. But a financial loss can't be deferred forever. Eventually, it has to land somewhere. And once these markets grow to a scale where they intersect with our pensions, our insurance companies, and our retirement accounts, the losses are no longer contained within a small club of sophisticated investors. They become embedded in the very institutions that support household financial stability. The loss doesn't disappear. It just waits to be absorbed. So, who are the potential absorbers? When the fog of creative accounting lifts, the losses will settle onto a few key balance sheets. First, institutional investors. Think pensions, insurers, and university endowments. For years, private credit was their answer to a world of zero interest rates, delivering the returns they needed. But if defaults rise and those high valuations are marked down to reality, their funding gaps widen. A pension fund that was counting on a steady 8% return might suddenly face a massive shortfall. This won't make headlines overnight. It appears slowly, in actuarial reports and quiet decisions to raise contributions or cut future benefits. The absorption is slow, but it is very real. Second, retail investors. The push to bring private credit to the masses has changed the game. Through new types of funds, these complex investments have been packaged and sold to everyday people, often marketed with phrases like stability and disciplined access. The shock for these investors isn't necessarily market volatility. It's the email announcing temporary withdrawal limits on a product they thought was liquid. They may not be the first to take a financial hit, but they often absorb the final loss in the form of reduced flexibility, a delayed retirement, or being forced to sell other assets at the worst possible time. Third, the banks. The term non-bank lending is a bit misleading. Banks are still deeply connected to the private credit ecosystem. They provide the loans that fund the funds, the warehouse lines, and the subscription financing. They don't have to hold the bad loans directly to feel the pain. When the value of the assets in these private funds drops, the collateral backing the bank's loans weakens. This forces banks to tighten their own lending standards, not just to the funds, but to the entire real economy. A system that claimed to be outside the banking perimeter still operates within its architecture. And finally, the fourth absorber, the state. This is often indirect. It comes in the form of public pension guarantees, insurance backstops, or emergency liquidity programs. The government doesn't need to bail out a private credit fund to absorb its risk. It can do so passively by allowing regulatory flexibility or capital relief to prevent a broader economic crisis. The question isn't whether private credit deserves a public backstop. The question is whether its sheer size has made one politically unavoidable. This creates a dilemma for policymakers. If they step in to help, they validate the shadow banking structure and socialize private losses. But if they refuse to intervene, credit could contract sharply, leading to a wave of corporate failures, job losses, and a serious economic downturn. Private credit grew to fill a void left by banks after the 2008 crisis. It became a form of essential infrastructure. And infrastructure doesn't get to fail quietly. For the average household, this entire complex architecture is invisible. People see their retirement balances, not the leverage ratios or accounting tricks behind the scenes. If the losses are absorbed through lower long-term returns instead of a sudden crash, the effect is subtle but devastating over time. Retirement dates get pushed back. Savings goals become harder to reach. The margin for error in our financial lives simply shrinks. Private credit didn't emerge by accident. It solved real problems and delivered capital where it was needed. But once a market grows large enough to influence pensions, insurance, and household retirement, it stops being an alternative. It becomes infrastructure. And infrastructure carries obligations. The final question is not about collapse, but about assignment. Who holds the risk? Who absorbs the loss? And who gets to set the terms? This is Más-Pope, analyzing financial systems under structural pressure. Thanks for watching.